The global debt surpassed $300 trillion. It is hard to imagine a number this big, but if we split it between everyone in the world, each person will end up with $40,000 in debt, including newborns.
Debt is rising every single day.
The global GDP, meaning the size of the economy worldwide, is 3 times smaller than what we owe. But there are 2 sides to every coin, and you can use all of this debt to your advantage. One of the most secure and time-proven ways to do this is through real estate. After watching this episode, you will know how to expand your investment portfolio through debt instead of drowning in borrowed money. In 2022, American households had more debt than ever, totaling $17 trillion. 70% of that is the mortgages of nearly $12 trillion. It surpassed all the student loans and credit card debts combined. Even though mortgages are the most widespread type of debt, they sure aren't the only one. 77% of American households borrow at least something. The loan amount almost always varies by age. People between 35 and 54 tend to have around $90,000 in debt, whereas all the other age groups have less money borrowed. Still, on average, millennials are believed to accumulate debt faster than all the generations before them. And more often than not, this is not a personal loan. So, if mortgages account for 2/3 of all the debt Americans hold, where does the other 30% of borrowed money go? Surprisingly, one of the most popular types of personal debt is the loan used to pay off other existing loans or credit cards. Economists call this concept debt consolidation. Of course, taking on more debt might create a vicious cycle and put more pressure on a person. Still, there is a positive side to this decision in some cases. Debt consolidation can result in lower interest rates and smaller monthly interest payments. Besides, it can be a way to simplify financial life with fewer bills to pay. But this is a topic for another video. So let's get back to the most widespread personal loan types. The second most popular reason for people to borrow is to improve living conditions. Approximately 17% of Americans take out loans for home renovation projects. Other common loans go towards emergencies and celebrations, mostly weddings. The paradoxical thing is that almost everyone takes on some debt. And it isn't just average Americans who try to make ends meet. Pretty much all the richest people in the world are also full of loans. But the main difference in the case of wealthy people is that they borrow strategically. We've already seen how billionaires use debt as one of the tricks to multiply their wealth in this episode. If you want to know how to leverage the same strategy without having millions in your bank account, make sure you check it out after watching this video. But for now, let's take a look at Elon Musk. He's a great example because he was named the richest American on several occasions, and even he takes on a lot of debt. Elon Musk was even named the most indebted CEO in the US. Why will the wealthiest person in the whole country borrow any money at all? Well, for many reasons. But first of all, to optimize his taxes and cash flow. Instead of selling Tesla shares and having to pay capital gain taxes, he borrows against his holdings. This gives him access to billions in cash for living expenses or business acquisitions whenever he needs it. In this way, Elon Musk doesn't have to pay taxes on debt because it is an income. Even though one might think that it looks like a dream life, the truth is that the richest people in this world can have very little cash flow because most of their wealth is in stocks and other assets. And there's nothing wrong with that. Still, if their investment portfolio isn't diversified enough, they can go bankrupt in a day.
I simply had loans against my stock. So if Tesla and SpaceX went bankrupt, I would go bankrupt too, immediately.
It is not just the wealthy individuals who borrow money. The biggest companies also rely on debt to grow and expand their businesses over the years. This type of debt is called corporate debt, and many experts believe it is out of control lately. Over the last 20 years, corporate debt almost tripled, surpassing $12 trillion. How do companies get all that debt? Well, there are several options. First of all, corporations can take a simple loan from a financial institution as everyone else does. Still, they have another opportunity that individuals don't, no matter how rich they are. Businesses can issue corporate bonds to take loan from investors that are not banks. These investors can be you and me. Think of a corporate bond as a IOU, which is a promise to pay from the issuing company to repay the loan with some interest on top. The business gets the money it needs, and investors receive interest payments in return. Once the bond matures, payments stop, and investors get their initial investment back. Many economists are worried about the rising corporate debt, and they call it a corporate debt bubble. When I say many, I mean it. This term even got its own Wikipedia page after the 2008 financial crisis. Still, the process of borrowing money shouldn't be bad, even if it's done in a large scale. A great example of this is Toyota. Surprisingly, it was the most indebted company in 2021, with almost $200 billion in loans. But what makes it a great case of debt usage is that it takes money to make more money. Toyota invested heavily in research, global operations, and marketing to maintain its position. As a result, the company maintained its absolute leadership in the industry with 10.5 million vehicles sold in 2022 alone. This shows that debt can be different. It can be both beneficial and catastrophic. That's why there is a distinction between good and bad debt. Bad debt usually refers to cases when we buy something that immediately loses value after purchasing. This can be anything from clothes and cars to an expensive 80-inch UHD TV for watching NFL games. Often, credit cards and the whole get now, pay later tendency make such spending easier. And as a result, we see the credit card debt hitting all-time high numbers.
We see more people carrying credit card debt.
43% of US households are carrying credit card debt from month to month. Americans between 40 and 59 are the ones that have the highest amount of credit card debt accumulated. Often, people that file for bankruptcy or have bad credit scores can't use credit cards because of the bad credit scores and extremely high interest rates. They have to use another borrowing tool, such as payday loans.
Payday lending is a $46 billion industry in the U.S.
That was the start of my payday lender journey.
Payday loans are a quick and easy way to get short-term cash when a person is in crisis. The problem is that the finance charges for these type of loans can be as high as $30 for every $100 borrowed. That's 10 or even 15 times higher than credit card interest rates. That's why a payday loan and a high-yield credit card are all examples of bad debt. Still, there are some loans that are tricky, and it is hard to say whether they are good or bad, such as getting a car loan, for example. On the other hand, cars tend to depreciate in value quickly, by up to 20% even before you drive it off the lot. Besides, if you buy an unreasonable, expensive luxury car without having enough funds to maintain it, you are generally getting into bad and unnecessary debt. Yet, if owning a car is a necessity for you, then getting a loan for it can be considered a good debt. Another controversial type of debt is a student loan. On one hand, it gives young people a chance to invest in their future, and the growing student loan industry is making it easier than ever to take out loans for college. But on the other side, over 45 million Americans are burdened with student loan debt, which is preventing many of them from progressing in their lives. On average, graduates have at least $35,000 in student debt. The amount of loans taken on by Americans in order to pay for college has now reached an incredible $1.6 trillion, which makes it one of the biggest sources of consumer debt. To an extent, the government understands they have to interfere.
The Biden administration is canceling $39 billion in student debt.
Okay, but then what is good debt? It is the one that can help you manage your finances better, multiply your wealth, and get assets that increase in value over time. One of the greatest examples of good debt is a mortgage. Many financial experts and Americans believe it is one of the best ways to invest in the future.
Now is probably a pretty good time to invest.
I see it as kind of the golden age for private lenders.
But what is the best way to expand your real estate portfolio through debt? There are more answers to that than many think. Of course, one of the first things that come to mind is buying properties and renting them out. We'll get to some important aspects of it in a moment. But for now, let's see some less popular options that are still very effective. What are those? One of the alternatives is real estate investment trusts, also known as REITs. REITs are companies that own, operate, or finance income-generating real estate. You can buy shares of these businesses and get dividends as one of the shareholders. Another opportunity is a real estate exchange traded funds, ETFs. It is basically a collection of stocks or bonds in a single fund. ETFs usually come with a broad diversification and low cost. A very similar option is a real estate mutual fund. Similar to ETFs, they also offer a mix of real estate assets. Still, a major difference between the two is that ETFs can be traded throughout the day like stocks, while mutual funds can only be purchased at the end of each trading day based on calculated price. Next comes real estate crowdfunding. These platforms allow several people to pool their funds with other investors to finance real estate projects. As a result, you can invest in properties or development projects without substantial capital. And another way of investing in real estate without buying properties is real estate notes or bonds. When you are investing in real estate bonds through a bank, you're typically buying debt tied to some property. Most of the time, these property bonds are issued by sponsors or construction companies. It's a way for them to get the funds they need and offer investors a chance to make some money with the interest payments. I'm already preparing a video on how you can use these instruments to invest in real estate for as little as $25. So make sure you subscribe so you don't miss the new episode. Now, back to this video. Aside from real estate bonds, REITs, ETFs, and mutual funds, you can always buy property. Getting a good deal requires preparation and research. Still, when you finally get a house, you can leverage both compound interest and value appreciation over time. Let's say you buy a home for $250,000 and it increases in value by 3 or 4% per year. When your 30-year mortgage is paid off, the property will be worth more than twice, perhaps almost 3 times what you initially paid for it, which is a significant return on investment. Besides, when it comes to real estate investing, leverage is a term you hear often. Leverage basically refers to the total amount of debt on a property relative to its current market value. When an investor uses debt to increase the value of their real estate holdings, it is usually seen as a positive thing. For instance, if you want to buy a $100,000 property, you might use $70,000 in debt and only $30,000 in equity for the down payment. So with just $30,000, you can own a $100,000 asset. Besides, if you buy real estate as an investment property, it will generate cash flow. The rent payments you receive from your tenants will help you pay down the mortgage each month. Over time, you will repay the $70,000 loan using the property's income, and you will fully own a $100,000 asset despite investing only $30,000 initially. That's the beauty of leverage in real estate. Many investors use leverage to increase their returns far beyond real estate. For instance, if you have a mortgage or car loan while simultaneously investing in a 401k plan or IRA, you essentially use borrowed money for your investments. Though it might not seem obvious, choosing to invest instead of paying down debt is similar to borrowing money for investment purposes. Besides, when you're just starting out in real estate investing, you have to learn some essential concepts. 2 of them are the debt to equity ratio and debt to income ratio. Both measure financial health, but they serve different purposes. The debt to equity ratio in real estate shows the amount of long-term debt compared to the property's equity. It tells us how much of the property an investor owns. To calculate it, divide the total debt by the total equity. For example, if you have $500,000 in debt and $250,000 in equity, your ratio is 2. That means you owe $2 for every $1 you own in the property. For a good debt to equity ratio, experts recommend aiming for a minimum of 70% debt and 30% equity. Now, debt to income ratio represents the sum of all your monthly debt payments divided by your gross monthly income. It is an important indicator to measure the affordability of your debt. So basically, understanding how debt works is one big step to building your investment portfolio. And the main lesson every beginner investor has to understand is that affordable debt spent on assets that appreciate over time is good debt, and there's no need to fear it. So tell me, how do you feel about debt invested in real estate and other assets? Let me know in the comments and I will see you in the next video. Bye-bye.